Good morning, everyone. Today we will finish the content that we have it from last week, and then we will have the new content about cash flow analysis. This week, I also post the assignment for the group work, and we're going to talk about assignment later after we finish the class today. Have you guys watched the two clips that I posted already? Yes or no? Yes. Good. So that will reduce some times that we're gonna discuss about how to calculate the EPS. I think it's quite complicated if you don't have accounting background before. But when you watch the clip, you can spend your own time. So you can pause it and then just replay, and then can help you understand better. Okay. So last week we talked about the income statement. First of all, I walk you through the content in the income statement, how the company identify the multiple step, single step income statement, how do they present the expense, they present by function and by nature. And then we go through the OCI section part. And then after that, we move to the analysis part that is about the common size, vertical, horizontal analysis, and then we go to the financial ratio analysis. So that's what we covered from last week on the income statement analysis. We also discussed some example of the real company, like how we identify the profitability of, this is the example of Korean King company, right? And a few more example on that one. And then we have the calculation on the profitability analysis. And last week we talked about the main item in the income statement, that is the revenue. Revenue is the first line item in the income statement. And then I draw your attention on how management have incentive to manage the revenue. That's on the revenue recognitions. If they can manipulate revenue number, for example, some type of business, they have some assumption and subjective, like the percentage of completion for the construction contract example. If the company can manipulate like the percentage number, they can identify the amount of profit that they want to recognize. So that's how we did on example from last week. So you guys can see that the company can show the amount of profit in the income statement, and the amount of profit is calculated based on the percentage of completion. So that's the percentage of revenue. How the company get the percentage is coming from, it can be the estimate of the engineer, right? And auditor have to verify that the percentage is reasonable or not. On the next slide, we have, this is the news from the Wall Street Journal concerning about the revenue recognition of Toshiba. If you look at this news, you can see that the Toshiba Corporation have to reduce their profitability. This is because there will be some mistake or some scandal when they report the profitability. So this is the real case that happened. The company has to reduce the profit during this period, right? Because the improper accounting of the project cost on the electric power system. So what's going to be an impact if the company makes this kind of scandal? We can see that there will be effect on the financial statement number, right? The profit has to reduce for sure, and also it draw attention, and it impacts several stakeholders. Like you have investor, right? Investor have losing the trust of the company financial number. So this will bring down the price, the stock price, and then also they're losing the trust of the executive. So they just ask the executive to resign from the company, right? And the company has to restate the financial statement number. So they have, because the past profit was overstated, so they have to restate it, right? And the reason they can manipulate the number because this is a project. So they use the percentage of completion. The company has manipulated the percentage of completion number. So that's really happened in the real case. So when you analyze this kind of company, read the footnotes, notes to financial statement. It will give you more information on how the company used the accounting policy and then present the financial statement number. Another company that we saw like news about these revenue recognitions is the General Electric. It was caught by the SEC on the revenue recognition again, right? In here you can see that the company has, the SEC investigated and showed that the company recognized the revenue from long-term service contract for the project. Okay, that's for the power plant, right? And the company report, this is the reported revenue. Okay. And part of this reported, it has this 15 billion of service contract on its book. Right? So after reading this, do you feel like, are there any problem with this? If we don't understand how they book their service contract, we may not know that this is the problem. Okay. I already explained about accounting equation, right? And I say that this is quite important. As an analyst, if you understand the logic that the company has to balance the accounting equations, you can find out that if they want to increase the revenue, how can the company increase the revenue? There will be two ways to make the equation to be balancing, right? What is the first way? Yeah, increase asset. That's one way. What is another way? Increase or decrease? Decrease liability. Opposite direction, of course, yeah. So here in this case, the company used this method, increase the asset. And the asset that they use contract asset. So the company has the growing amount of the contract asset showing in the financial statement. So these are the assets based on the revenue, okay? Because before it has the cash in hand. So that means the company book contract asset and increase the revenue, but didn't collect the money yet. So that's how they cook the book, right? So they say that finally, eventually they will get the cash, but the cash has not come in. Right? So you have increasing in the revenue. And for this kind of manipulation, you can see that the profit will increase, but the company has no cash at all. How can you detect this kind of problem? Can anyone suggest me? If the company manipulate the number like this, you have revenue increase, you look at the income statement, oh, the income statement profit looks good. How do we know that the company has a problem?
Look at cash flow statement.
Good, yeah, very good. Look at the cash flow statement. What is the name?
กริดครับ
Good,
ใช่ครับ
very good. Look at the cash flow statement. They will not have the cash from operating activity. The CFO or cash flow from operating activity will be very, very low. Okay, so you can identify this is the problem. Have the profit but no liquidity for this company. Are there any other way that we can identify the problem? The second way. Let's try. Great, yes. Look at the amount of contract asset. So you go to balance sheet, another financial statement, balance sheet. Try to calculate the growth of asset from prior year, right? If you spot any item that growing too fast, then find out more why it's growing very fast. Okay, so that would be another way, right? Or you can look at the turnover of the contract asset, right? So that is another way to identify this. So based on this, the company identified that the contract asset is calculated based on GE's own estimates and assumptions. So no wonder they can report very high contract asset, right? So finally, they have to restate the financial statement, and this caused the stock to reduce. The price just going down, and it's like half 45% down comparing to the past 12 months. So that's an impact. So when the investor has this kind of scandal, then the investor, they just don't like this company anymore. So it will have an impact on the share or the stock. All right. So in real case, you guys will see this kind of problem, right? And then in your project, you're gonna have to identify the problem. How do we detect this kind of problem? Right? The company that I pick for you for your project, it will be the company with the problem. We already know the problem, but what I would like to challenge you is that, can you find out the red flag of this problem before we know the other problem? So I think it will be very, very interesting for the term project for this semester. Okay. Other than that, there will be the small discussion on the revenue recognition in the special case. In the general case, general rule, we look at the control transferring. So if the company transfer the control to the customer, company can record the revenue recognition for sure. If they have revenue recognition before the delivery, like during the production, or this one related to the percentage of completion that we discussed here. And if you finish the production, then the project is completed, then you can recognize the revenue. We also can have some other type of special case. The company sells the product with buyback agreement. This kind of condition, it doesn't mean that you already transfer the control. You sell it today and then you have agreement to buy back later with the price higher than the selling price. Let's say you sell at 10 million, you buy back at 10.1. This is the real sale. No, what are they? Borrowing, yeah, it is a borrowing. It's like a borrowing. And then you have inventory as a collateral. And then later on you pay back with the interest. That's why you buy back at the price higher than the product. Another thing is sales with the right of return. This is the normal situation. The company sells and customer can return within a certain period of time, right? So if you have this kind of sale with the right of return, on the day that the company sells, the TFIS 15, the one that we are using right now, the company has to estimate the amount of return on day one. So let's say you sell at 100, you have to estimate how much the customer will return. So if you estimate 20% you return, then you have to subtract the sales return amount from your total sales and show net sales 80 on day one. So this is related to variable consideration, the 5-step model that we discussed before. Yeah. On 5-step model, the variable consideration, the amount of your revenue, you have to consider any variable of interest, for example, the amount refund. If the company have a refund, it has to be reflected in your net sales. And after you estimate the refund, there will be another thing on the cost of goods sold or cost of sale. The cost of this total sale is one of the 100. The cost is 30. The refund is 20. So you have to estimate the cost of this refund and book this as a contract asset. This one. So the company will have contract asset, and then this amount is also less the amount cost of sale. The return that you reduce the net sale, you have liability, we call refund liability. So these two numbers are booking together. Okay, if you look at the accounting equation, asset equal to liabilities plus equity. You have sales return to reduce the amount refund, right? So that the sales return will reduce the revenue, equity will reduce, and then you book liability. This is the refund liability. Refund liability increase. Another thing is you have contract asset. This is the cost of the refund item because it's not refund yet, right? So you're gonna show this as the amount of contract asset. Okay. So you have the contract asset, right? You have contract asset on this one, and it will reduce your cost of sale, right? So it's like you estimate that this amount finally is going to be returned. So you not sell it out. Customer will return later. So it will reduce your cost of goods sold. So in your equity section, when you look at the cost of goods sold, this amount will reduce the cost of goods sold, right? And it will decrease your equity. Yeah. So in the income statement for the refund item, the company has to estimate from the day one, and you will have the increase in the contract asset. So if you spot in the income statement, you can see that, oh, this amount can be the balance of the return item in the future. That's the company estimate. Okay. Another issue in the revenue recognition would be like when you have the coupon or discount, give it to your customer. This one should be recorded by subtracting from the revenue. Normally the company will present, they prefer not to subtract the revenue. They try to mislead by present as the marketing expense. This is wrong. So the coupon or discount, it should be net of the revenue, not the marketing expense. The fulfillment cost, this is the shipping and handling cost, right? So this one, how can the company book this cost? When you have shipping cost to sell the product to the customer, how can you book it? Cost of goods sold, right? It's part of the cost of goods sold, not the marketing expense. So marketing expense is wrong again. You can see that the company doesn't want to book this on the revenue or on the cost of goods sold because they want to boost the gross margin. So they use the classification techniques, classify as the marketing expense, but that is incorrect. Okay. The license fee and membership fee should be recorded on the term of agreement. So you have to allocate over time, right? Barter revenue, do you know what is barter revenue? So barter revenue is like you have the company A and company B. They have their own product, and then they just trade their product, right? So it's like barter revenue. So you don't receive real cash, but you just trade the product for these two companies, right? For example, you could think about like the internet. On internet, you have the website, company A has the website, and then have the advertisement on the website, right? Company B also have its own website, and then advertise the company A product item on company B. This kind of thing we call barter transaction. So when you recognize the revenue, we will use the fair value of the similar non-barter transaction. Okay. So you have to find the price, the fair value of the price of the product. Can you repeat your question? I cannot hear. Yeah, it could be the services, the product or services, yes, for both of them. So the key point is you have to find the fair value and then recognize the revenue for both companies. Good. The last one that you will see the issues will be the agency revenue. Something like Travelocity or when you buy the airline ticket, you go to Expedia.com, something like that. This is we call like the agent. It's not the company who owns the real product. So in this case, when the Expedia.com recognize revenue, they will record using the net balance, not the gross balance. Okay. Like for example, you are selling the airplane ticket, right? The ticket costs $1,000. You're selling at this price, and then when customer pay, you charge the customer extra 10% more, right, on this price. So when the company record the revenue, it should be the balance of the revenue you collect from customer net, the net balance. So here you can record only the 10% as your revenue. This is your commission revenue, right? Not the gross amount. The gross amount is the amount of airfare. It should be the revenue of the airline ticket. Then be the case that the company can record the gross amount with the 4 criteria condition. That's the only one case. The case is that the company has the obligor under the contract, and then you bear the inventory risk and the credit risk, right? You can choose supplier, and then you can set the price. But in case of Expedia, they cannot set the price by itself. The airline has to set the price, right? And the airlines bear the risk. If the customer doesn't buy the ticket, the loss is going to the airlines, not the agent. So that you cannot record the gross. It should be the net price, net amount here. Okay. So I think that's kind of the issues that we normally find in the revenue recognition. All right. Now, this is example. Actually, it's similar to what I explained here. You show the gross profit. So for the agent, then you have to show the revenue at the net amount, not the gross amount. The last part will be this is the note, just the note for the agent company, the Amazon.com. I think you guys can read it by yourself, so I'm gonna skip this one. The last part will be EPS. I asked you guys to watch this clip before. Okay. Anyone hasn't watched the clip? Can you please raise your hand? You all watched the clip, right? Yeah. So what the key content from the clip that you guys get? The way how to calculate the EPS, right? Yeah. So I'm gonna go quickly, just try to wrap up what you learned from the clip. Before I'm starting, do you have any questions? Like any part that you want me to specifically explain? Yes.
The treasury stock method, it assumes like you get the money and buy back some.
Right.
But in reality, the true outstanding share actually increase as they exercise, right? Not
right.
Okay.
Yes. Yeah. Good point. The treasury stock method, like the stock option that you issues, right? We are applying the treasury stock method. So we're assuming that we receive the money and then the stock is buyback, and the net increasing is the net increasing of the stock, right? But in reality, yes, you are right. The stock option that the company has, the real stock in the amount of the stock has been exercised. Yeah, that's the total amount increase. Very good. So for the basic EPS, it's quite easy. You just have to find the weighted average number of shares outstanding. That will be your denominator, and your numerator will be the net income minus the preferred stock. That's for the basic EPS. You can get this amount from the income statement. The company will present this. And as an analyst or as an investor, you can analyze that, the company, how much the EPS you will get if you invest in this company, right? However, you also have to consider the complex capital structure. That's the company has the financial instrument that can be convertible into the common stock later, and it will dilute the EPS. So as a shareholder, you will reduce your EPS in the future if this kind of financial instrument has been converted, right? So we have to calculate the diluted EPS. So we have two methods, the if converted and the treasury stock method. Okay. For the preferred stock and convertible bond, we assume the if converted method. Who knows what is if converted method? Can you guys explain to me? Yes. Easy. Just explain in words. You don't have to do the calculation. It's just the concept of if converted method. Right, yes, very good. So we just assume that if they converted, what's going to be the diluted EPS that the shareholder will get, right? So when you calculate the weighted average number of shares outstanding, you have to weight by the month that the company has that among shareholders. So this is example how do you weight the weighted average share outstanding, right? So like on the first million, then you use apply 12 months, and then on the 200,000, this is issued on April 1st, you just multiply by 9 months, and then you use October 1st, that's one, you just multiply by 3 months, so that's the weighted average number of shares outstanding. And then we calculate the diluted EPS of the convertible preferred stock. Here, we know the net income, we know the average common share outstanding is given already, and we have 20,000 convertible preferred shares. So we're gonna assuming that this one is converted, right? So in the diluted EPS, if you use if converted method like this, the preferred share has been converted, so we don't have to pay preferred dividends. So we don't have to minus the preferred dividend out of this, and we have to add the new share issues if the preferred stock converted, and then we use numerator divided by denominator, that is the diluted EPS. Right? You can see that it reduced from the basic EPS all the time. Right? So that's the convertible preferred stock. For the convertible debt, we also apply this if converted method again. Right? So we calculate basic EPS first, that's the net income, this is the weighted number of shares outstanding. So this is given already. And then we have 6% convertible bond. This is the 6% means is the interest, right? So you have to use the if converted again. Right? So if this convertible bond is converted, you don't have to pay for the interest. So you have to add back the interest expense net of tax. Net of tax. And then your denominator, if it is converted, this is the new share issues, 10,000. And then this divided by this is the EPS. Right. Okay. The last one is the treasury stock method. This is for the stock options. We have net income and the weighted share outstanding. The basic EPS would be very simple, right? This one divided by the weighted share outstanding. For the diluted EPS, we have to assume that the option is converted. Option is exercised. Yeah, this is exercised. So this exercise price 35, and then you have 30,000 options. So you multiply, right? 35 for 30,000 options. This is the amount of cash that you will get if this option has been exercised, right? And then you divide it by the market price of the stock, and then use this one will be the repurchase stock, the treasury stock. Okay, and then the net balance of this, of the new share issues, that will be the new shares that we're gonna use in your calculation. Okay. So we're gonna use this balance, this will be the new shares added to the weighted average share outstanding at then you calculate the EPS. This is part of your CFA exam test as well, how to calculate the EPS, the diluted EPS here. Okay. Sometimes when you calculate and then your EPS is larger than the basic EPS, for this kind of the financial instrument, we call it anti-dilutive security. Okay. The anti-dilutive will not be included in your equation of diluted EPS calculation. So we're going to use only the EPS that diluted in the calculation. So I think that's it for the content that we learned from last week. So we have income statement analysis, and then we talk about income dimensions, the operating, non-operating, recurring, and non-recurring. In your analysis of sustainability, sustainable growth of the income, these dimensions are important. If the company are sustainable in the future, the main income should coming from core operation, and it should coming from the recurring part. That indicate the earnings quality of the company, right? So it should come from that part. And pay attention on the timing of the revenue recognition, because we know that management has incentive to manipulate the earnings number. And the last part will be the EPS. Alright, any questions on this topic? Can you guys follow me so far? Yeah. Anyone cannot follow me, can you please let me know so we can adjust a bit to help you understand better. Are you guys okay? So far so good? At least please give me some smile so I know you guys are okay. Alright. Okay, before we go into the next topic, that will be the cash flows. I'm gonna ask you to do the questions. So this one will be bonus point, part of your participation score. Okay. There will be 3 questions. I'm going to ask you to do. I give you 6 minutes on these 3 questions. So it's about 2 minutes for each question. Some of them I think you just read and then you can answer. The question is drawing from the content of the clip on the income statement, the EPS that we discussed, and another one is on the cash flows that I asked you to watch. Okay. So please take your cell phone. I'm going to show you the QR code. Yeah, you can scan the QR code and then please enter the student